Okay, I need you to stop scrolling for a second. Put down whatever you're doing. Because what I'm about to share with you, this is the conversation that most people, the vast majority of hardworking, intelligent, well-meaning people never get to have. Not because they don't deserve it, not because they're not smart enough, but because nobody ever sat them down and said, "Hey, there's another way." So I'm going to be that person for you today. Let's talk about money. Let's talk about freedom. Let's talk about what it actually looks like to reach a point in your life where you wake up on a Monday morning and, get this, you don't have to go anywhere. You don't have to clock in. You don't have to answer to a boss. You don't have to sit in traffic for 45 minutes each way just to spend 8 hours doing something that doesn't light your soul on fire. That's financial independence, baby. And it is absolutely 100% without question possible for you. Now here's the painful truth. For most of us, and I mean the vast, overwhelming majority of working people, there are really only two roads that lead to that destination. Road number one is the long road, the slow road. The road that society practically programs us to walk from the time we're old enough to open a bank account. It goes like this: work hard, spend less than you earn, save whatever's left over, repeat for 20, 25, maybe 30 years, and eventually, if the math works out and the markets cooperate and inflation doesn't eat your lunch, you retire. You get your gold watch, you collect your social security, and somewhere around 65 or 67 or even later, you finally get to exhale. Now, I'm not here to trash that path. For a lot of people, it works. Slow and steady wins the race, right? But here's what I want you to really sit with for a moment. That path asks you to trade decades of your life. Prime years. The years when you've got your health, your energy, your creativity, your hunger. You're trading those years for a finish line that's 30 years away. And what if there was a shorter route? Road number 2 is the road less traveled. The road that Robert Frost was really talking about. And this is the road where instead of just saving money, you deploy that money. You put your dollars to work. You build what I like to call an income engine, a collection of assets that generate real, consistent, reliable income that can actually replace your salary. Not someday, not eventually, but potentially in a matter of years, not decades. That's what we're talking about today. 3 specific, powerful, proven asset classes that can produce the kind of income that sets you free. And I've spent over 2 decades as a financial advisor watching people navigate both of these roads. I've seen who makes it. I've seen who doesn't. I've seen the mistakes. I've seen the wins. And today, I'm pulling back the curtain on all of it. Let's get into it. Asset number 1, dividend stocks. The income machine that works while you sleep. All right, let's kick things off with my personal all-time favorite, my ride or die, the investment strategy that I am personally on right now. And that is, drum roll please, a portfolio of high-quality dividend-paying stocks. Now, before you roll your eyes and go, "Oh great, dividend stocks, I've heard this before," stay with me. Because the way most people think about dividend investing is completely, fundamentally, dangerously wrong. And the way I'm going to explain it to you today might just blow your mind a little. Here's the question I want you to ask yourself before we go any further. What's more important, the return on your money or the return of your money? Read that again. Because most investors are laser focused on the wrong thing. They see a stock paying a 10% or 12% dividend yield and their eyes go wide. They think they found a golden goose. But here's what the smart money knows. Those sky-high dividend yields are almost always a red flag. They're not a gift, they're a warning. Companies that are paying out enormous dividends relative to their stock price are often in trouble, burning cash, struggling to compete, propping up their stock price with payouts they can't sustain. And when those dividends get cut, and they almost always eventually do, the stock craters and you've lost not just your income stream, but a massive chunk of your original investment. That's not a strategy. That's a trap. Here's what I'm actually looking for when I'm building a dividend portfolio. I want to find companies that are operationally excellent. They've got a real, thriving, cash-generating business, not a house of cards, not a financial engineering scheme. A genuine, competitive, durable business. Defensively positioned. They've got what legendary investor Warren Buffett calls a moat. Some kind of competitive advantage that makes it really, really hard for competitors to eat their lunch. Maybe it's brand recognition. Maybe it's patents. Maybe it's a network effect or switching costs. Whatever it is, I want to see that moat is deep and wide. Conservatively financed. This is huge. Companies that are drowning in debt are companies that are one bad quarter away from slashing their dividend. I want to see clean, conservative balance sheets, cash on hand, low debt relative to earnings, led by trustworthy management. This is the part that doesn't show up in the spreadsheet, but I can't overstate how important it is. A company with a brilliant, shareholder-focused, long-term oriented management team is worth so much more than one being run by people who are just there to collect their bonuses. Companies like this, they typically pay dividends in the neighborhood of 3, 4, maybe 5%. And I know what you're thinking. That's it? That's what you're excited about? Yes, and here's why. Because those companies don't just pay dividends, they grow their dividends, year after year after year. If you look at the dividend-paying companies in the S&P 500, the real blue-chip stalwarts, they have a remarkable history of raising their dividend payments at a rate that outpaces inflation. Which means that if you retire today living off your dividend income, that income stream doesn't just hold its value, it grows, it compounds. It keeps pace with the rising cost of living. That's not just income. That's a self-inflating income engine. Now, I want to be completely transparent with you here, because this stuff matters. Dividend stocks are not a get-rich-quick scheme. They're not without risk. During the financial crisis of 2008 and 2009, even some historically rock-solid dividend payers, particularly in the financial sector and in energy, had to cut or suspend their dividends. When credit markets seize up and businesses can't raise capital, dividends are one of the first things to go. So you've got to go in with your eyes open. And I also want to say this, and it might surprise you coming from someone with my background: don't try to do this alone. I have credentials. I've spent over 2 decades in finance, and I am not personally picking my own dividend stocks. Why? Because the kind of analysis you need to do this right, the deep credit analysis, the business quality assessment, the ongoing monitoring, that is a full-time job. I want someone who is doing this 30, 40, 50 hours a week, who has been doing it for 15 or 20 years, who has a documented track record of delivering consistent, growing income to their clients. They're not trying to beat the S&P 500. They're not shooting for the moon. They're finding diamonds in the rough, high-quality income producers that the broader market might be sleeping on. And they're building portfolios that put their clients in a position to live comfortably off their dividends for decades. Find someone like that. Trust them. Let them do what they're great at. It's worth every penny. Asset number 2, real estate, the tangible wealth builder. Handle with care. All right, let's move on to number 2. And this one is really interesting because it's the one that I've seen the widest range of outcomes with, from spectacular success to catastrophic failure. And the difference between the two almost always comes down to one thing. But first, real estate, rental properties. Whether that's single-family homes rented to individuals, small multifamily properties, or even commercial real estate like warehouses, retail spaces, or office buildings, the fundamental idea is the same. You own a property, someone pays you rent. That rent covers your costs and ideally generates a profit. Repeat across multiple properties, and eventually that rental income stream replaces your salary. It's one of the oldest paths to wealth in human history. And for good reason. It works. But, and this is a big but, the world has changed. And if you're looking at real estate right now in today's market, I'd encourage you to be really thoughtful. Here's my honest take. I would not underwrite any real estate deal today assuming significant appreciation in property values. That era may not be over forever, but right now, with where interest rates have gone and where valuations are in many markets, assuming that your property is going to go up dramatically in value on top of generating rental income is a dangerous assumption. It's the kind of assumption that can lead you to overpay for a property and find yourself underwater when the music stops. Instead, here's how I'd think about it. Can this property generate positive cash flow? Meaning, after all the costs, mortgage payments, property taxes, insurance, maintenance, property management fees, vacancy reserves, can it still put money in my pocket every single month? If the answer is yes, even with conservative assumptions, that's worth exploring. If the answer is no, or even maybe, pass. There will always be another deal. Now, the difference between the real estate investors I've seen thrive and the ones I've seen struggle, and I've seen people go bankrupt in real estate, it's genuinely heartbreaking, comes down almost entirely to financing. The clients I had who built durable, lasting real estate portfolios that truly freed them financially, they were obsessed with conservative financing. They put more money down than they had to. They didn't stretch for properties at the top of their budget. They kept reserves. They ran their numbers assuming things would go wrong, because sometimes they do. A tenant stops paying. A roof needs replacing. Interest rates rise and refinancing becomes expensive. A commercial tenant decides they don't need as much office space in a post-COVID world. The real estate investors who survive those moments are the ones who weren't over-leveraged in the first place. And here's something I always found revealing. The best real estate attorneys, the ones who know this world inside and out, typically have two practice areas: real estate and bankruptcy. Think about what that tells you about the kind of risk that's built into this asset class when it's not managed carefully. Real estate also isn't passive in the way dividend stocks are passive. Being a landlord means being a business owner. Tenants call, things break, leases expire. You need to find good property managers or be prepared to manage things yourself. It's not a set it and forget it strategy. It's a hustle. A rewarding one potentially, but a hustle nonetheless. That said, I've seen people with no financial background, no fancy degrees, no Wall Street connections, regular people, build life-changing wealth through real estate. Not by swinging for the fences, not by gambling, by being patient, disciplined, conservative, and consistent. If that sounds like you, this could absolutely be your path. Asset number 3, the diversified portfolio, the strategy built for everyone. Okay, here we go. Asset number 3. And this one, I say this with full conviction, is the one that's going to resonate with the broadest range of people listening to this right now. No special expertise required. No need to find a rare specialist. No tenants to deal with. No leaky pipes. No vacancy headaches. This is the one that works for everyone, from the person just starting out to the seasoned investor who wants to simplify their financial life. I'm talking about a well-constructed, properly diversified portfolio of stocks and bonds. And the strategy of generating income from that portfolio, not just through dividends, but through a combination of dividends, interest income, and yes, long-term capital gains. Here's why this matters and why it's different from just a dividend stock portfolio. When you have a broad diversified portfolio, think a mix of growth stocks, dividend payers, bonds across different maturities and credit qualities, maybe some international exposure, you're not just collecting dividends. You're building total wealth that you can then draw from strategically. And here's the kicker. Long-term capital gains and qualified dividends are taxed at significantly lower rates than ordinary income. For many people, especially early in retirement, the effective tax rate on this kind of income can be remarkably low, sometimes even 0. So the play is this: build a portfolio with real diversification. Understand what your sustainable withdrawal rate looks like given your expenses and timeline. And work with the tax code, not against it, to keep as much of that income in your pocket as possible. This isn't sexy, I know that. But you know what is sexy? Looking at your account statements and realizing that your portfolio is generating enough income and capital gains that you genuinely, mathematically, do not need a paycheck anymore. That is sexy. The piece that ties it all together, your financial plan. Here's something I want to be crystal clear about, because I see people overlook this constantly and it drives me absolutely crazy. All 3 of these strategies, dividend stocks, real estate, diversified portfolios, they only work as part of a comprehensive, thoughtful financial plan. I cannot tell you how many people I've worked with over the years who were actually financially independent, who genuinely had enough income from their assets to cover their expenses, but who were still going to work every day because they didn't know it. They hadn't done the math. They hadn't modeled it out. They were living in financial uncertainty when the reality was they were sitting on financial freedom. That's a tragedy, and it's avoidable. You need to know with clarity and confidence exactly where you stand. What are your income streams? What are your expenses? What does inflation do to your purchasing power over time? What are the tax implications of drawing down your assets in different ways? What happens if markets have a bad 5-year stretch? What's your contingency plan? A proper financial plan answers all of these questions. And a good one doesn't just tell you the numbers. It tells you how to feel about the numbers. Because one of the most common things I saw in my clients was people who were financially ready to retire, but psychologically terrified to spend their savings. They'd spent 30 years accumulating. Spending it down felt wrong, even when the math said they could do it comfortably for the rest of their lives. A great financial plan, built with real software, real projections, real scenarios, gives you permission to live your life. The final word: don't wait. If there's one thing I want you to take away from everything we've covered today, it's this: the cost of waiting is higher than you think. Every year you spend on the slow road, grinding away, saving incrementally, watching your best years go by, is a year you could have been building these income engines. Every year you delay building a dividend portfolio, or acquiring your first rental, or putting your money into a properly structured, diversified portfolio, is a year of compounding you'll never get back. And perhaps most importantly, every year you could retire but don't, because you're not sure, because you haven't run the numbers, because the idea of not having a paycheck is terrifying, that is a year of your one and only life that you don't get back. The number one regret I heard from clients in my 20+ years as a financial advisor: I wish I'd retired sooner. Not later, sooner. So do the work. Pick your path. Build your income engine. Make the plan. And then, When the math says you're free, believe it. Because you deserve to live the life these strategies can give you. Let's go.